The United States Treasury just did something it has not done in decades. In a move that stunned currency traders and rattled global markets, the U.S. Treasury Department intervened directly in foreign exchange markets. It sold dollars and bought Japanese yen in coordinated action with the Bank of Japan. This was not a rumor. It was not a trial balloon. It was executed intervention, confirmed by both governments. It represents one of the most significant shifts in American monetary policy in a generation. Currency intervention of this kind is rare. The last time the United States took similar action was in 2011, following the Fukushima disaster. Back then, the dollar surged against the yen and threatened to destabilize Japan's recovery. Before that, you have to go back to the 1990s to find comparable precedent. But this time, the context is different. Japan is not recovering from a natural disaster. The global economy is not in freefall. What changed is something far more structural and far more dangerous. The Japanese yen had been collapsing, not gradually, not in response to predictable economic cycles. It had been falling at a pace that threatened the stability of the world's third largest economy, and by extension, it threatened the architecture of global finance. For months, the yen weakened against the dollar as the Federal Reserve kept U.S. interest rates elevated. Meanwhile, the Bank of Japan maintained its ultra-loose monetary policy. The gap between American and Japanese rates created a powerful incentive. Borrow yen at near zero cost, convert it to dollars, and invest in higher-yielding U.S. assets. Traders call this the carry trade, and when it unwinds violently. By late April 2025, the yen had fallen to levels not seen in over 30 years. The exchange rate reached 160 yen to the dollar, a threshold Japanese officials had repeatedly warned was unsustainable. Import costs in Japan spiked. Inflation, long dormant in the Japanese economy, began accelerating. Political pressure mounted on Prime Minister Fumio Kishida's government to act. Then came the intervention. On the morning of April 29th, Tokyo time, the Bank of Japan began selling dollars and buying yen in massive volume. Within hours, the U.S. Treasury confirmed it was participating. The combined force of both central banks hit the currency markets like a sledgehammer. The yen surged. The dollar fell. Traders who had bet on continued yen weakness were caught in a violent reversal. This was not a symbolic gesture. Early estimates suggest the intervention involved tens of billions of dollars in combined firepower. The exact figures have not been disclosed, but foreign exchange reserves data and market movements point to one of the largest coordinated interventions in modern history. Why this matters goes far beyond one currency pair. When the United States Treasury intervenes in currency markets, it signals that the normal mechanisms of global finance are no longer functioning. It means that market forces alone cannot be trusted to correct imbalances. It means the world's largest economy has decided that stability requires direct action, even if that action contradicts decades of stated policy favoring free-floating exchange rates. It also sends a message to every other country watching. The rules are no longer fixed. If the U.S. will intervene to support the yen, what does that mean for the euro, for the yuan, for emerging market currencies that have been battered by a strong dollar? And perhaps most importantly, it raises a question that has not been asked seriously in years. Is the U.S. dollar too strong? And if so, who decides when to weaken it and how? To understand why the United States Treasury intervened for the first time in over a decade, you have to understand how we got here. You have to understand how the Japanese yen became a systemic risk. This crisis did not begin in April 2025. It began years earlier. It began with decisions made in Washington and Tokyo that set two of the world's largest economies on a collision course. The divergence begins 2022 to 2023. In March 2022, the Federal Reserve began raising interest rates aggressively to combat inflation. Inflation had surged to 40-year highs in the United States. Over 18 months, the Fed lifted its benchmark rate from near zero to over 5%. It was the fastest tightening cycle in modern history. Higher U.S. interest rates made dollar-denominated assets more attractive. Global capital flowed into U.S. treasuries, corporate bonds, and money market funds. The dollar strengthened against virtually every major currency. Japan, meanwhile, did the opposite. The Bank of Japan, under Governor Haruhiko Kuroda, and later his successor, Kazuo Ueda, maintained its yield curve control policy. This was a commitment to keep long-term Japanese interest rates near zero, no matter what. The BOJ argued Japan's economy, still scarred by decades of deflation, could not withstand higher rates. Inflation in Japan remained low. Wage growth was stagnant. The central bank held firm. The gap between U.S. and Japanese interest rates widened to levels not seen since the 1990s, and the yen began to fall. The carry trade expands, 2023 to 2024. By mid-2023, the yen had weakened past 140 to the dollar. Hedge funds, investment banks, and institutional traders saw an opportunity. They borrowed yen at Japan's near-zero rates and converted those yen into dollars. They invested in higher-yielding U.S. assets. The difference in interest rates, sometimes 5 percentage points or more, became pure profit. as long as the yen stayed weak or weakened further. This is the carry trade, and it works beautifully until it doesn't. The more traders borrowed yen, the more yen they sold. The more yen they sold, the weaker the yen became. The weaker the yen became, the more attractive the trade looked. It was a self-reinforcing loop, and it grew into one of the largest positioning bets in global markets. Japanese officials began issuing warnings. Finance Minister Shunichi Suzuki said in August 2023 that excessive volatility in the yen was undesirable. BOJ Governor Ueda hinted that intervention was being considered. But no action was taken. The warnings were ignored. The yen kept falling. By the end of 2024, the exchange rate had reached 155 yen to the dollar. The breaking point, early 2025. In January 2025, two things happened that accelerated the crisis. First, the Federal Reserve signaled that U.S. interest rates would remain elevated longer than markets expected. Inflation in the United States had proven stickier than anticipated. Fed Chair Jerome Powell made clear in his January press conference that rate cuts were not imminent. Second, the Bank of Japan reaffirmed its commitment to loose monetary policy. Governor Ueda stated that Japan's inflation, while rising, was not yet sustainably above the BOJ's 2% target. Yield curve control would continue. The interest rate gap widened further. The yen fell harder. By March, the exchange rate hit 158 yen to the dollar. Japanese import costs surged. Energy prices spiked. Food prices rose. Inflation in Japan, which had been 1.5% a year earlier, climbed past 3%. Public frustration grew. Politically, the situation became untenable. Prime Minister Kishida faced declining approval ratings. Opposition parties accused the government of allowing the yen to collapse. Business groups warned that import-dependent sectors were being crushed. On April 15th, Finance Minister Suzuki held an emergency press conference. He did not announce intervention, but he used language that currency traders recognize as a final warning. "We are prepared to take all necessary measures," he said. Markets tested him. The yen fell to 160.5 to the dollar on April 28th, the weakest level since 1990. The intervention, April 29th, 2025. At 9 a.m., Tokyo time on April 29th, the Bank of Japan began selling dollars and buying yen in the foreign exchange market. The initial wave was large enough to move the market immediately. Within minutes, the yen strengthened by over 2%. Then came the surprise. At 8 p.m. Eastern Time on April 28th, simultaneous with Tokyo's action, the U.S. Treasury Department confirmed it was participating. Treasury Secretary Janet Yellen called the move a joint effort to ensure currency stability and prevent disorderly market conditions. This was unprecedented in recent memory. The United States does not intervene in currency markets lightly. The decision requires approval at the highest levels of government. It signals that the situation is not just a Japanese problem. It is a systemic risk to global financial stability. By the end of the trading day, the yen had surged to 152 per dollar. Traders who had borrowed yen and bet on further weakness scrambled to unwind positions. Losses mounted. Volatility spiked. The intervention had worked for now. But the deeper question remained unanswered. Why did the United States decide that saving the yen was worth abandoning decades of stated policy? What risk was so severe that it required direct American intervention in a foreign currency market? The answer lies not in Tokyo, but in the interconnected architecture of global finance, and in what happens when that architecture begins to crack. The most revealing part of this story is not that intervention occurred. It is how quickly, how forcefully, and how many markets reacted, as if something larger had been contained at the last possible moment. Step 1. A market that stops behaving normally. In the days leading up to the intervention, currency desks were watching for one thing: disorderly trading. Disorderly is not a moral judgment. It is a technical diagnosis. It means price moves accelerate beyond what economic fundamentals can explain in real time. Liquidity thins, bid-ask spreads widen. Options markets price in sudden extreme swings. The yen's slide had begun to show those hallmarks. Sharp moves during thin trading hours, rapid one-way positioning, and increasingly violent intraday reversals. That matters because foreign exchange markets are the plumbing of global trade. When that plumbing begins to shake, it is not just Japan that gets squeezed. It is any company pricing imports, any bank rolling short-term funding, any government trying to service debt. Step 2. The first strike, Tokyo moves. Japan's Ministry of Finance, which has legal authority over currency intervention, typically acts through the Bank of Japan as its agent. When Japan intervenes, the first clue is not an announcement, it is a footprint. Traders look for outsized, sudden buying in the spot market. They look at the timing, often clustered around the Tokyo Open. They look at the scale, a move large enough to break through technical levels that had held for weeks. They look for a surge in volume across electronic platforms, and for corresponding stress in derivatives as hedges are repriced. When the yen jumped sharply, that footprint appeared. The move forced funds positioned for further yen weakness to cover, meaning they had to buy yen back quickly at worse prices. That alone can amplify an intervention's impact. Step 3, the confirmation. Washington joins. The truly destabilizing moment, paradoxically stabilizing for markets, was confirmation that the United States was involved. U.S. participation usually runs through the Treasury's Exchange Stabilization Fund. That is not routine. It is a tool designed for moments when currency instability threatens broader financial conditions. When Treasury signals it is acting with a partner government, it is telling the market this is not a bluff, and it may not be a one-day operation. In official language, interventions are justified as efforts to counter excess volatility and restore orderly market function. That is side A of the story, a defensive move to prevent a disorderly yen decline from triggering a wider financial accident. Step 4, the market reaction. The carry trade unwinds. Side B is more political and more consequential. A rapidly weakening yen is not just Japan's problem. It can export deflationary pressure to trading partners and distort trade flows. It can trigger sudden losses in leveraged positions tied to yen funding. A violent carry trade unwind can ripple into U.S. credit markets, equity volatility, and even Treasury liquidity. Because funds sell what they can to meet margin calls. That is why the reaction was not confined to USD JPY. Traders also watched implied volatility in FX options, which tends to spike when markets fear cascading moves. They watched cross-currency basis swaps, a stress gauge for global dollar funding. They watched equity futures, which often dip when leveraged trades are forced to unwind. And they watched Japanese government bond yields, which can move sharply if policy credibility is questioned. What we know and what remains unclear. What can be measured is the price action, a rapid yen appreciation and a sudden repricing of risk across correlated markets. What remains unclear, absent full official disclosure, is the scale and structure of the operation. How much was deployed, whether it was sterilized, whether it was a single strike or a campaign, and what would trigger the next round. And that uncertainty is not a footnote. It is the story. Because once the United States uses direct currency intervention, the world begins asking a different question. Not whether Japan can defend the yen, but whether the global monetary order is entering a phase where governments must repeatedly step in to stop the market from breaking itself. A coordinated US-Japan currency. Intervention is not primarily about Japan's pride or America's optics. It is about the stability of the financial system that underwrites US power. The yen is not just another currency. For decades, it has functioned as one of the world's principal funding currencies, a low-rate base for leveraged bets across global markets. When that funding currency collapses too quickly, the unwind does not stay in foreign exchange. It migrates into equities, credit, and sovereign debt, because leveraged players sell whatever they can to meet margin calls. That is the first strategic point. A disorderly yen move can tighten financial conditions in the United States. It can do this without Congress passing a bill or the Fed changing a rate. It can hit American borrowing costs through volatility alone. The second point is even more direct. Japan is among the largest foreign holders of U.S. Treasury securities. That relationship is often discussed in diplomatic terms, but it is mechanical. If Japan's currency weakens sharply, Japan's import bill rises, and domestic inflation pressure increases, political demands grow for countermeasures. In that environment, Japanese institutions can face incentives to repatriate capital. They may sell foreign assets, including treasuries, to stabilize balance sheets at home. A sudden large wave of treasury selling is not just a bond story, it becomes a U.S. fiscal story. Higher yields mean higher interest costs for the U.S. government. It means higher mortgage rates and less room for maneuver in a crisis. The third point is geopolitical. Japan is a central pillar of U.S. strategy in the Indo-Pacific. A weak yen is not merely an economic inconvenience. It becomes a domestic political stressor in Tokyo, driving inflation in an import-dependent country. It squeezes household living standards. Political instability in Japan would not remain domestic. It would complicate defense planning, regional deterrence, and allied coordination on sanctions and export controls, particularly in a period when the United States is trying to maintain unified pressure on adversaries and keep supply chains resilient. Then there's the fourth point. This intervention telegraphs to the world that currency stability is now being treated as a security issue. For years, major economies have insisted markets should set exchange rates, with official action reserved for extreme volatility. When Washington steps in, it effectively redraws that line. Other capitals take note, both allies who may now expect support, and competitors who may see an opening to test the system. Finally, there's a broader structural implication. The dollar's strength has become a source of global strain. A strong dollar raises the cost of dollar-denominated debt worldwide and pressures emerging markets. It can destabilize trading partners. By acting to support the yen, the United States is implicitly acknowledging that unchecked dollar strength can produce strategic blowback. financially, diplomatically, and militarily. This is why the intervention matters. It is not just a market headline. It is a signal that the guardians of the post-war financial order believe the plumbing is under stress, and that they are willing to use extraordinary tools to prevent a crack from becoming a fracture.